Drew son, it is 12:06, or as we like to say,
It
we're
feels
early.
like I haven't seen you for a month.
I don't think I have seen you for a month.
Yeah.
That's a nice shirt you got there.
Yeah, still pushing for that. What do you call it? Not sponsored, but brand ambassador. Yeah, still waiting. Doing my best.
I see a comment from Miss Graham in the chat already. What shirt will D Mitty be repping today? That's good. So it's what is it? What brand?
R&G.
Okay.
As always.
R&G. Well, that's nice for you. Must be nice, Drew. We've got a few questions to answer today. There's been a lot sent in. One of the things, Drew, that maybe you didn't see is anyone that gets their question, I think it was the first 5 questioners on today's show get free Rask merch. So
and a book.
They can have a book.
Yeah.
There you go. They can have a. What's your next book? What's the new book you're working on?
We've actually come up with a title or a concept. We were asked if we could sell more of our existing books before we launched a new book. I think what would the comparison be? Maybe like John Addis's "How Not to Lose $1 Million." Not that, but the idea is, lessons from advising 1,000, families or clients over what's just turned over into 2 decades of financial advice
for you personally.
So I like the structure of John's book, where it was like what he did wrong, what he didn't do but was wrong, what he could have done better, and like those multiple angles. And we naturally have seen so many situations. So how do we get those into a concise, interesting and multi-angle book? So look out for that in 2028.
I like that idea because I think you did briefly mention that to us before Christmas, but that's a really good idea. Kylie and Claire in the chat. Claire has asked, is R&G rod and gun?
It is.
My hobby.
It is.
Yes. Yeah. Claire, what do you think of the shirt out of 10? For anyone that's not watching live, it's a...
I call it like Italian Riviera holiday shirt, maybe.
Yeah, I call it like golf top.
Yeah, it actually looks golfish too. Yeah,
it does, because it's kind of got like the collar with the
Anyway. New Year's resolution to play more golf.
Is it?
Yeah.
So I got to the end of the 18th hole. So had some chats with some great people over Christmas. About 60 different investors actually over Christmas, just had to catch up with them. And Claire's giving you 9.5 out of 10.
Oh, I'll take that.
That is a sharp score there.
I'll pass it on to my stylist.
Wow. Anyway, I was on the golf course over Christmas. Haven't been on one for about 6 years.
What were you doing there?
Well, I didn't realize that we were going to play golf with the family over Christmas and all that sort of stuff. And I was taking investor calls as I was going around the course, just chatting with folks in the Rask community. It was heaps of fun. And at the end, we're playing in teams. And so I was with my cousin, Andrew. And on the 18th hole, it came down to this, like all the teams were even coming into the 18th hole.
Oh, like an Ambrose.
Yeah, Ambrose, exactly. I didn't know what that meant until I got there. And on the 18th hole, I had a bit of a wedge onto the green, and I was lining up, ready to hit, about to position myself, not knowing at all.
Listen to you with all the golf lingo.
Yeah, wait for it. And I thought when you leant over the ball, like if you wanted to wedge it up in the air, the ball should be towards your back foot so you can kind of like get underneath it. You know what I'm saying? Then he's like, mate, in order for the ball to go up, you have to, like, it has to be at the front of your foot, basically. He'd been watching me hack the ball for 18 holes, and he tells me on the last shot of the day, basically, how to hit the ball. I'm like, unbelievable. So anyway, it worked.
It worked? You won?
No, we lost. By one shot. Yeah.
You wedged it straight over the green to the other side.
Yeah. But hey, Drew, is the stock market going to crash in 2025? True or false?
Not in 20. I mean, the question you asked was, is the stock market going to crash? And I say always yes. Whether it's going to crash in 2025 is anyone's guess. And I don't think anyone who says it's going to doesn't know what they're saying. Anyone who says not going to doesn't know what they're saying.
Yeah, true.
You're just guessing.
Hey, Dave. Good to see you in the chat. So I want to do a bit of pop trivia. You always catch me off guard with these.
Oh, no.
What percentage of calendar years, so what percentage of years does the stock market fall?
What percentage of years? I'd say it's like 22%.
Gosh, you were close.
Oh.
Yeah, it's 19%.
I just saw one of those. Is it like the distribution, the curve bell distribution, whatever, bell curve?
Schultz
The other
curve,
day that plotted all the S&P 500 returns, and you could tell that very few of them, like the entire bell curve, was basically zero, and 80% of it was above zero.
Yeah, so I'm going to show you something, and anyone that's watching,
There you go, 1 in
g'day
5.
person.
Yeah,
Yeah. So if I'm going to show you the screen for anyone that's listening, I'll talk you through it. So you can head to this website. I've just discovered it over Christmas. It's called Curvo, like CURVO.eu. And it has amazing data on every single market in the world. But let's say, for example, we're looking at the S&P 500 index, and it's got all the compound, blah, 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 all that data. Like last year returned 34%. But if you go down to here, Drew, it shows you the histogram, right?
yeah, that's the word I was trying to get.
81% of the years between 1993 and 2023 was positive, right? That's the kind of
Only
thing you're talking about.
1993.
1993 to 2023, so that 31 years.
You could take that back 80 years. I reckon it looks very similar.
Yeah, so I'm going to now show you something else, right? So I'm going to go Curvo, NASDAQ.
What does that mean? Just keep putting money in the market; it'll always go up.
Well, that's 1 in 3 years it goes backwards, which is obviously wrong. But if we keep going down,
it also can go backwards 3 out of 3 years. These are historical averages.
That 1 in 5 years, there could be 3 of them in a row. Like in the 1970s, there were 2 or 3 years where it went backwards like 30%. So, like that's absolutely devastating. There's the Great Depression, there's the GFC over 50%. So, if you look here, so we've just brought up exactly the same data set, but for the NASDAQ 100, this only goes back to 2008 for this data set. It's only got a sample of 16 years, so 81% it's exactly the same number, right?
Yeah.
Now we're like, well, what about Australia? So let's go to the market index website. And if we go 124 years of data, and we can see this here, positive years, 81%. It's exactly the same for every single market that I look at. Is this like some sort of Fibonacci? Like, am
Illuminati,
I reading?
You've worked out.
Am I like looking at the stars? Like if something happened, but like I'm not like a superstitious person whatsoever, but it's just there's like this rhyme that it's like around about 1 in 5 years.
Can you get one for property markets? Just want to start the year on an aggressive note.
That would be positive all the time because it only goes up.
Yeah, exactly. It is a good reminder, and this is what I talk about all the time. You've got different types of investments you can put money into, but investing into the share market, investing into companies are living, they're evolving, they're innovating, they're growing, or they're shrinking at different times. You just put us on there and put into the matrix. Yeah. And it's a kind of reflection of that 4 out of 5 years, companies have, as a group, have tended to grow.
Yeah.
Versus other, and not saying property hasn't done the same thing, but other assets that can be depreciating, require to put more money in, and aren't necessarily evolving and impacted by other influences.
You're singing to the choir. Are you singing? You're preaching to the choir, my friend. So here we got the drawdown chart of the S&P 500, and so like you said before, the bad years are like seriously freaking bad.
Yeah.
So like obviously the GFC is 51%. In 2002, the drawdown was like 40%. In COVID, or just after COVID, actually, it was 23. COVID, it was like
bounced back quickly.
20. But what you notice, so what this chart shows, for anyone has ever studied a drawdown chart, what it shows you is the time it takes to get back to its all-time high, but also it shows you how far it fell. So if it's like a big hole, it shows you how far it fell and then how quickly it got back up to its previous high.
That's from the top too, isn't it? Yeah.
Yeah. But what you often notice with these drawdown charts is what it shows you is that almost all of the time, the stock market is near its all-time high. So like people might need to double take on that. Almost all of the time, it's near its all-time high, or it's on its way back there.
To it.
And so what that tells you is that if you're freaked out that the stock market is near its high, you probably need to get used to that because it almost always is. And, that's just the reality.
I think what there's something that chart shows, which is pretty much every client I meet at the moment is asking, is it okay to invest in a share market? Every headline's overvalued. S&P's at all-time highs. CBA's overvalued. Nvidia, all the tech companies are overvalued. I've heard people saying different earnings or these ridiculous earnings multiples that are on companies. And everyone thinks it's the market falling 30, 40 or 50% that's going to do the damage. But in my experience, and I mean, it's obvious, the actual damage comes from what action you take when that happens. So more often than not, not more often than not. And even the smartest people at some point, when the market's fallen 50% from its high, the amount of phone calls we get that are pretty basically like, I just want to protect what I have left is the kind of,
which makes sense.
Like, and it's natural because you've seen half your wealth disappear, or half the wealth that's invested in shares disappear incredibly quickly. But what we've shown in time, and those charts all show it, that time and time again, the people who sell may never actually recover what they had before, where the people who hold on, stick to a strategy, stay invested, will always recover faster, and at some point will recover.
Yeah. It's interesting though. Like, so if anyone, I had a chat this morning with a great fellow named Mick. People are freaking out right now that the US stock market's really high. Donald Trump's just got back in office. And I'll ask for your 2 cents on that in just a sec. But I think about this a lot, right? I don't know what Donald Trump's going to do tomorrow, or what he did even this morning, what he had for breakfast. It doesn't really, I just don't know.
McDonald's and Coke.
He probably had McDonald's and Coke with RFK and Elon Musk on some private jet. But I don't know. And if you think about it, no one really knows for sure.
Who cares?
And so,
just buy the dip.
Yeah, JF James has just said, just buy the dip. BDK did say the Great Depression stock crash happened in the year of the snake, FYI. So this could be the second snake. The snake could be coming back to bite you, Drew. Lee says, thanks for keeping me company while I'm in courier mode. Well, you're very welcome. What I would say is just generally that we don't know. And as you were just saying, the key thing is having a plan.
Yeah.
So like, you might not know all the scenarios, but you might know like 4 or 5 of them. So for example, James here just saying that the strategy is, if the market falls, I'll just keep buying.
Yeah.
That might be your strategy. Like if the US falls 20%, I buy 20% more. It might be, I don't know, if Australia if the Australian dollar gets to X, I sell US and bring it back to Australia. It could just be whatever. Just write them down. Have those scenarios ready. So in the moment, you're not guessing what the next move should be.
And a big part of what an advisor does, and we also get this question all the time, is, what do I get? How do I get value from the advice or the fees that I'm paying? And the big value of what an advisor does is have that framework and that process in place. So when something does go wrong, they're able to stop you or have you prepared or have diversification or have confidence that you've got enough money that you don't need to take action. You don't feel like taking action. And that's, unfortunately, it's unquantifiable because you can't actually tell what benefit that will have, whether that correction will happen, how you'll stop it from occurring at the time. But it's like time and time again, I've now invested through 2007 through we were talking about the pigs yesterday. Remember the European crisis?
Portugal, Ireland,
I've completely forgot about that. So you had that. You had the
ceiling.
Quantitative easing unwind. I think that was like 2012.
Chinese property crash.
Yeah, you've invested through all of those and having a framework, rebalancing. We couldn't even tell you how much money it's either saved or made for clients over that period.
Yeah, absolutely. The behavioral kind of sounding board is the key thing there, right? So there was something I did want to ask you about. Oh, yes. Actually, for everyone that's watching and listening, you may remember that we did I'll bring my screen back. It's going to show a horrible face.
Blow the siren.
No, we're not blowing the siren. So you might remember we had the $10,000 portfolio challenge that we aired on the 2nd of January. So if you're not aware, we did an episode on basically New Year's Day, and we all had to pick our $10,000 portfolios. Pardon me, including the community. So there was like the Rask Dizzy Rascals, that's the Rask community one. Then there was Drew's one, which is everything portfolio. And then there was my
Also,
portfolio, which was chosen by Monique, which is this is the best one. But it turns out this is the best one is actually not the best one, because if we jump into Navexa, so far Drew is winning,
tearing
so,
away.
So Dizzy Rascals,
I haven't
you
even looked at
guys,
this yet.
the community. Yeah, I only put it together today. You guys are currently up 3.92%, and your biggest winners are KKR. Kev Tui.
Kev Tui.
Kev
Shout
Tui
out to
coming
Kev
through.
Tui at Atchison.
Wow, Kev Tui's is coming in with 11% capital gain. What a bloody legend.
You know,
Followed by ASML. That's a
4
currency gain
weeks.
there too. Let's be honest.
That's all currency.
And you've been weighed down by Vulcan. Oh God. But it's not that bad just yet. So then the other portfolios, I'll go with my one because it's not that good. This is the best one. Is up 1.87.
Was it your resource holding that's pulled you back, or?
Yeah, well, RPM Global's down 10%. So, XRF Scientific's down 8%. Jeez. But my Home Depot shares, because of the currency gain, are up 6.5. ResMed up 7.5. So just got a bit of a tail risk here, Drew.
Home Depot in, yeah.
But remember what we said, folks. You look at this portfolio, it is not our actual portfolio. Full disclosure, it is not our portfolio. It is strictly not. But you will be able to view the portfolios hopefully by the end of today at www.raskmedia.com.au/portfolio. You'll see it live.
Banter is welcomed.
Yeah.
We put a thread on Rask community that everyone can critique the portfolios too.
Absolutely. Just smash into us. Now, the everything portfolio by none other than Dr. Andrew Deremuth is actually winning. You're up 4.63%.
Delicious and high performing.
Delicious. Everything. I actually had everything eggs this morning, and it was bloody great. But you got all these like whack ones. You've got like these funds and whatever. So I'm just going to say that. Your top performer is NVIDIA.
The Munro, the X20.
Yeah, it's
pretty much is it everything up?
Everything is up. You're 100%
everything up. Everything up.
Everything up. But one of the things that you've also...
I thought NVIDIA was in a bubble.
It is, but the bubble has got a bit bigger. You've also got ResMed, copy me on that one. I didn't know Microsoft is $446 a share these days. Isn't that wild? Like I remember... Look at this all-time chart, 446,000%.
Yep.
I mean, wow.
Does that mean it started $1? Yeah.
Yeah, that's 10 cents. Wow.
10 cents.
So my question to you was going to be, we'll keep you updated every week on the Australian Investors Podcast. Just hit subscribe on YouTube or on your podcast player, and we'll keep you up to date. And you can view the portfolios at raskmedia.com.au/portfolio. Drew, I was going to ask you, Trump, what does that mean for you?
Not much. I mean, it's taking up a lot of media and taking up a lot of feeds and putting a lot of uncertainty out there. And I think it's driving markets in the short term. But I think you saw nothing unpredictable and nothing that wasn't already flagged come out in the first announcement of the inauguration. Seems to be good for billionaires. There was a laundry list of billionaires at his inauguration. And I mean, it's you can see outside of the some parts of the policy that we don't want to go too political here, but it's kind of a pro-American growth in many ways. Spend more money in America, spend more money on infrastructure, release reduce tax rates, release restrictions, red tape, all that sort of stuff, which pro-American company growth, not necessarily pro-America as many people would say. It suggests it is, but it kind of sees a continuation of the last few years, doesn't it?
Yeah. The big thing that's on everyone's mind is not everyone's mind. Everyone's got other things to think about in their life for sure. But
did he say dig, or was that?
I don't know.
Is that one of his quotes? Yeah.
But I think that the thing that people maybe think about is does all the spending and all the pro-America have adverse consequences in 2 years, 3 years, kind of like last time with COVID, right? It ended up in huge inflation.
Well, like what's happened in Australia, where put too many finite resources into one sector. It inflates the cost of building, inflates the cost of salaries in that sector, and extracts and creates inflation elsewhere.
Exactly.
That's
And
the
then,
risk. Maybe it's less impactful, and what can actually be executed in the US. I think that's the biggest risk. But as far as drill baby drill, sorry, it wasn't dig dig dig, it was drill baby drill. I think that's more about oil. Just getting the heads up. There
thanks,
you go.
Steve.
Claire
Thanks,
put it up
Claire.
there as well. Yep. But I think whenever you talk to people and look at American policy, it sounds like there's been a significant underinvestment in infrastructure anyway. Like you drive through some of those roads in some of the biggest states and cities, a lot of the infrastructure needs a lot of money. So,
hey, I'll tell you something fun. Ben just put something in the chat. He said, I refinanced my home in October 2022 and went deep into leveraged NASDAQ. Just had a look at the portfolio today and it hit $450,000. People's reactions to market pullbacks when everything is on sale. Every friend I know sold out of the market entirely and have missed the entire rebound. The reaction does all the damage.
Need some new friends.
I started in 2016 with 20K with a payout from the company I worked for when the company that I worked for went into administration. What a journey. Ha ha. Oh, wow, man. Wow.
Some of the questions are great. We had a few good questions on the retirement podcast yesterday too. There was someone talking about, he's going to retire for good and he wasn't going to be able to go back to work because he was just going to tell people how he really thought when he was leaving work. So he needs a retirement strategy that kicks off right then. It's amazing.
That's so good. Marcus says 2026 is the crash. Interesting, Marcus. Feel free to expand upon that, please.
We have two predictions. 2025 will be the crash and 2026 will be the crash too.
Yeah. I reckon we could have one every year.
Yeah. I mean, we have like 25 every year.
Yeah.
I think some of the forecasts for the S&P 500 for this year have you seen that come through from all the investment banks?
Oh, I've seen the 10-year forecast, but not the 1 year. What is the 1 year?
All the boffins have got something like 18 to 19% returns from the S&P 500 again.
Oh, wow.
Yeah. I mean, it could fall 30 and then go up 80 from there.
I'll give you a bit of pop quiz. What do you reckon the NASDAQ, so obviously like peak, performance, what do you reckon the NASDAQ is currently trading at in price earnings terms? Price earnings like next year, forward price earnings. I'll bring it up while you do that.
In price earnings terms?
Yeah, so like what's the P ratio of the NASDAQ 100 stocks?
46 times.
Forward, like next year's?
35 times.
Right. So I'm just going to go into the NASDAQ ETF from MetaShares. This is like the thing that I always look at with this ETF, other than like other things, but this is the one thing. 26 times.
Oh, that's not bad.
That's what I mean.
Some people think 18 times is expensive.
I actually don't think 26 times forward PE ratio, assuming that the actual earnings, like the E and the PE, are a real thing, which they probably are. I actually don't think 26 times for probably the best companies that have ever existed is a bad thing. Like, I mean, yeah, the earnings might not exist and the valuations might fall, but to be honest, I don't think that's that bad.
I think we live in a different time now too. Like the days of value investors and the Buffetts, the Mungers, being able to find, looking for a company that's trading on 8 times earnings, or the market's cheap when it's under 12 or 13 times. I think we just live in a completely different world now. Most companies aren't cyclical. They're not asset heavy. Basically, they're all asset light, and all their value is in intellectual property. Yeah. So naturally, your market, and this is one of the problems with the kind of moving average of the PE of the market, I think, is that it feels like it's always undervalued because we're so used to it being lower and industrial in the past, that we should actually be used to higher multiple, higher growing, more flexible companies.
Yeah, that's fair.
Famous last words.
Yeah, and also don't say anything about Charlie.
I'm waiting for my copy of the Almanac.
Well, you come to the office. There's heaps in there. It's a very expensive book to give away, though, mind you. That hardcover behind me is like $60.
I need something to help me fall asleep.
Oh, 1991. So I've just got for anyone that's not watching, we'll just bring this up a bit more. Since 1991, the NASDAQ PE ratio has been majority over 20 times. So there have been some spikes, obviously, around GFC and whatever, just random things. But the majority of the time since 1990, it's been over 20. So, like, if you think that 20 is expensive, it's probably not. It's probably normal. 26 may be slightly over the valuation. Don't use this as a forecast for what's going to happen, mind you. The thing, just stop sharing the screen for everyone. One of the things I should mention before we get into the questions is that any of the information that we share on today's show is strictly limited to general information only. It's not personalized financial advice. You can see a financial planner like, say, Drew here, or anyone that you can find and verify on the moneysmart.gov.au website. Make sure that the AFSL says active and the financial advisor is actually qualified to give you advice. And if we mention things like PDSs or like ETFs or super funds or insurance or whatever, they'll come with something called a PDS. That's a product disclosure statement. It tells you everything you need to know about, say, the ETF. And importantly, you should read that before you invest. And if you're anything like us, you wouldn't invest until you've read something like that, because why would you invest for the long term in something you actually don't know what it is? So anyway,
I got a quick question for you too. This might be
then.
self-promotion, but I think this is quite interesting given the headlines and discussion, everything that occurred during 2024. So we've just finishing off quarterly reviews for our clients, and in that we kind of look at the 12-month returns from our model. What do you think the 3 top performing investments were? I think most of our model for 2024 for the year.
Like, you're talking about individuals, companies and ETFs and funds?
Yep. Or the broad, not the asset class, because I think that's too broad. I think you'd be able to guess. And they're 3 completely different, one from each different asset class.
Oh, you shared these with me and I now have forgotten. Did you?
They're quite amazing, to be honest.
No, I'm just going to have to go, I don't know, because I remember you had...
What's the most overvalued company in Australia?
CBA?
Yeah.
Yeah.
45% last year.
Wow. I remember you also had a property position that I was like, that's really interesting, and that did really well, and I can't remember what that was. Charter Hall? Or
we held Vicinity, the Chadstone shopping centres.
Yeah.
It wasn't that.
Okay, what was the other 2? What were the other 2?
What's the most overvalued sector in the world at the moment?
Well, US shares.
Yeah, so Munro.
Well, I was going to say Munro, yeah. But did you have the small and mid cap, or did you have the global fund?
Not for the whole year. We had the global fund.
Okay. Yep. What did that do?
I think it was like 42 or something.
Wow.
Again, that's holding not just the Nvidias and the Amazons, but big US tech. This is a growth tech strategy as well.
Yep.
And then up there with the 2 of them, I think they're all over 40%. Was gold bullion, unhedged gold bullion.
Yeah, very well with the currency movement as well.
Not expect that to have 2 equities and a commodity as your top 3. I thought that was super interesting.
That is really interesting. We made a decision to move out of gold 2 years ago because rates were back, baby, and we're getting income from our bonds, but the bonds haven't really moved compared to gold, so that's been a bit disappointing. But we do have some questions, and the first one here is like a bit of a reminder to Dr. Andrew Dermuth. The question comes from pronunciation.
I'm always great.
I'm going to let you answer this one, Drew.
Enunciation or pronunciation?
Pronunciation. Is it pronounced Rask or Rask? I have heard Andrew Dermuth on the Australian Investors Podcast say it a bit differently. How would it appear in the transcript or auto-generated text? So is it Rask or Rask?
I can put it into my Otto right now, Otto, and see how it comes up if you want.
But what do you think it is, Drew?
I mean, I'm an Aussie, so for me it's Rask.
Very posh Aussie by the sound.
Rask.
Yeah, so
Rask. It seems American. I think.
No, see, it is a Rask because that's
Rask.
how I've pronounced my surname. Probably someone from Poland or.
How do you pronounce Derby? Derby or Derby?
Derby.
Derby.
So people get confused with the name Rask because people get confused with the name Rask. I'll answer your Derby thing in a second. Because they think it's like task. Because in Australia we say task, but it's spelled task, right?
Test.
Yeah. So just think the easiest way to think of the pronunciation is like a rascal. You don't say rascal, you say rascal.
Don't you?
Right? I don't. Anyway, what were you saying about derbies?
No, how do you say it, Derby or Derby? And that kind of explains it.
Yeah, okay. How do you say castle?
Castle?
No, I don't know that either.
Castle.
I get a lot of stick for that actually online. People let me know about that one because I always talk about moats. That's the whole thing. Not Empty Nest writes in and says, what is the best way to assist our children to get into their first home, Drew? There'd be a lot of your clients that
Let
would
them
be
live at home
thinking about
longer.
that. No, you want to get them out of that house and into another one. Not Empty Nest. So this is a good question. Many different approaches, isn't there, to helping your children get into a house? It's unfortunately we're at a point where that is probably the number one thing on parents and grandparents' mind is helping kids or grandkids afford to buy a place. And it's really unfortunate for everyone that doesn't have that leg up. But what is the way if parents and grandparents are going to do it?
There's a few different ways, and the bank of mum and dad's incredibly popular. Like a lot of our clients, we're still seeing when we meet them, they've allocated $100,000, $200,000 towards deposits for their children at some point in the future. Some have acquired properties while they were accumulating, and their investment properties they intend to pass on to their children. But obviously, not everyone's able to do that. The trickle down from that would be helping them with a portion of the deposit. So, and there's always the question of, is it a gift or is it a loan? Which that's where some probably complexity comes in. Guaranteeing loans. So where someone doesn't quite have the 20%, the ability to guarantee. But probably the more interesting one, and Jamie, I have to be honest, when ideas come from someone other than me these days.
You got to pay it where it's due, Drew.
He thinks every time we talk about something in our office that I just put it on here and claim all the credit for it, which is 100% true. But one is the First Home Savers.
Super Saver Scheme.
Yeah, Super Saver Scheme, which basically you can contribute to superannuation for, get the tax benefits and then draw it out. And I believe you could do it on behalf, you can contribute on behalf of your children. They get the benefit of it and then take it out to make that deposit in the future. So that's another way that has a bit more flexibility and helps them with the deposit again. I think they're the main ways, but they've all got risks and drawbacks. Banks will always want you to gift the money, but depending on the amounts, you might want to be protected in some ways. You might want to have a loan agreement, but it's incredibly just the price of houses in within not even CBDs, but within metropolitan cities is just crazy at the moment. And you're better off trying to buy in Adelaide or Perth and not living in Australia. You're getting significantly more value, and that's I think why more people are rent investing or renting a house, having an investment property somewhere else.
Yeah, absolutely. I think the only wrinkle to helping your children out is if you as the parent have an interpretation or a perception about the child's relationship. So if you think that the relationship might not last, or you just don't agree, or you think there's a risk or something, you need to be mindful that if you gift money to them and they're going to buy a house, that might actually, that might actually backfire in the sense of they might break up. The other partner, like the child-in-law, may actually end up with the house, and so you just got to be able to be mindful of that, I think. But for the most part,
expect it to be a gift.
Yeah. But another thing you can do, Drew, is if you've got a home as a parent, is you can just go guarantor. And in some instances, that will allow the child to not have a deposit.
And borrow more,
Yeah. So if that's the case, then effectively they've got a slightly bigger loan. But if they've saved a deposit, they can then use that to renovate the house or to fix it up or to buy furniture or all that sort of stuff. And knowing that the loan is theirs. And crucially, you don't have to refinance. Like the child doesn't have to refinance to remove you from the loan. Once the bank is satisfied that there's enough equity in the home, they can often just remove the guarantor component without doing a refinance. But there are some wrinkles to that. Like if you have plans with your house to leave your current house and you use that house as security for your children's house, you won't be able to move. So there's issues around that. That there's pros and cons with everything, and the banks now will actually want you to get a lawyer's opinion that you understand the
Sign-off,
risks. Yeah. So CBA does that, for example. But ultimately, it's just about your children presenting a compelling, like I think it is. This is my opinion. Presenting a compelling case to you for your support. You could be more on the front foot and gift money. Like I spoke to someone over Christmas, a young lady who's very much got her head on her shoulders and very bright and motivated to save and do all that. And her grandfather, who had done remarkably well off his own back, he actually gifted them $250,000 for Christmas.
Yeah.
And she already had a mortgage and everything, and she put it basically straight on that. And so that would be a wonderful gift. But if it's a gift, it basically goes into the ether, and then you're giving them responsibility over that amount of money. So just make sure that they're on board. And with the guarantor perspective, is make sure that the children put together a pretty compelling case of when they will remove you from the loan.
And I think there's a kind of another wrinkle here, and I mean, part of it comes from the kind of die with zero concept, but I think people are thinking about this more and more, and it's where advice can be valuable too, is that, don't you want to give money to your children, family members when it's most impactful?
Yeah.
So that's why a lot of people are bringing forward the bank of mum and dad. But the key there is making sure that when you're doing it, you're not giving up the lifestyle that you have built and grown and saved towards, and giving up too much of that in benefit of your kids. So it's making sure what you're doing is you're able to justify, and that you're still going to have that, be able to have your capital outlast your lifetime, basically. But bringing forward gifting is incredibly, I think it's growing, and it makes sense.
I think it probably makes more sense now
in a wealthy country like Australia.
I think if wealthier people aren't mindful of this, they very much should be. That in the next 5 to 10 years, I think we're going to see some sort of change in the way parents support children. And what I mean by that is, I have a pretty strong belief that the gifting rules, the helping kids out with houses, that sort of stuff, the passing the money along, I reckon that's going to change, because I think there's going to be enough social uproar about like a lot of inequality in housing, in particular. But I also think that if you look across the world, everyone else has got inheritance tax, and we don't. Death tax basically, and so I think that there's going to be significant change. So I would be starting to think about that sooner rather than later if I was parents, even if it's not giving them money, just being aware that changes may come. That Cliff says the problem with going guarantor is that if the loan goes pear-shaped, then the guarantor can be up for any legal fees involved in the bank taking legal action. Absolutely, Cliff. Like, it's not just like, here's a piece of paper and you go and buy your house. It's you can't leave. You're on the hook. Like, there's slight differences between co-borrower and guarantor, but co-borrower is another option, and that means that you're effectively putting your income, like your salary or whatever you've got, and you're a part owner of it. So that's another option, and a good mortgage broker can help you out in structuring that. But it's not a free pass. In fact, Cliff, you did say a question live here in the chat, which says, "Hi guys, looking at core ETFs, do you see a place for passive funds that have a factor like quality, moat, etc., or do you see those as satellite positions?" I think it depends on what it is, Cliff. Like, I can't give personal advice, but
starting the year with an "it depends."
I'm just trying to be more risk aware now, Drew. I've just been through the ringer on a bloody licensing application. Yeah, so I'm just, actually, I'll reveal more about that in the near future. But I think that for example, the quality ETF from Van Eck, which is QUAL, is one of the most popular ETFs in Australia because it invests in, I think it's 150 or 300 global stocks, and it does it for a pretty low price, but with a quality filter over the top. I think that's a pretty good ETF, to be honest with you. With the Moat ETF, it's slightly more active. You pay about 50 basis points or 0.5% in fees, and you get a 40 to 50 stock portfolio that's been rated by Morningstar's analysts. I think that that's more satellite-esque and more active-esque than the quality position, because the quality is more diversified. There is one thing I wanted to maybe share this. I didn't think I was going to share it today, but I will show you something. You answer that, Drew, while I
I
get
kind
this.
of see them as situational too, kind of like you're saying. And if I'm building a core, I either want it to be completely passive and low cost and giving me the index, or I want it to be completely active and really swinging. These are kind of halfway. They're
Yeah.
kind of backward and forward looking. They're rules based. So I prefer to be at the other end of that. And then in periods where quality is going to pay off, where interest rates are increasing or the economy's slowing and you want quality, that's where I use these kind of situationally to get that tilt or to overweight
Yeah.
in certain sectors. Or so what you're talking about is a factor or a style.
Yeah. This ETF here, and this is what is, I think, the future for Australian investors. So my old haunt, the Motley Fool, has a different range of ETFs in the US. So these is like the Motley Fool, everyone knows it as like subscriptions and stock ideas and whatever.
Yeah.
But the Motley Fool in the US, and in particular David Gardner, one of the co-founders, is like one of the most brilliant investment services, probably the best, to be honest. But they've actually turned some of their memberships into ETFs. So this is like, as if you're going to buy your own stocks, you could just pay them to do it. But when I first come across these, I'm like, these are active ETFs. They're kind of cool. There's 100 stocks in there, pretty well diversified. Turnover rate of 25%, which inverse means that the average holding period is 4 years. Like I was looking at this and I was thinking, if this type of thing comes to Australia, which it's starting to now, I think that these could be part of a core portfolio because this is exactly what an active, or it could be something that's like in a satellite. So it could be both. It really comes down to fees, diversification, track record, all those different types of things for me, Cliff. But we can actually invest in US ETFs, but I don't like from inside Rask Invest. But if this type of thing is available, I'd consider it as part of a core portfolio because I would blend it like Drew does. I would have a very small part of my portfolio in something like this. It wouldn't be like an IVV or an VAS type holding, but it might be like a 5% or a 2%.
Complement,
yeah, something like that. So I just thought that was really interesting. I was just reading up about this over Christmas, and I thought it was a really compelling ETF. So yeah, there was another question that came through. This is a good one. This is from Pickle Down Rickonomics. So I don't know.
Trying to work out what the zeitgeist is this year.
So the zeitgeist for Pickle Down Rickonomics, I think this is a reference to not Futurama, Rick and Morty, where he's a where he's a pickle, but also trickle down economics. So anyway, Soul Pats hanging on to if you're a holder or investing if you're not an investor. I think that's what it says. I have been a long-term fan of Soul Patch, much like the one and only Mr. Owen Rask. But the share price has been treading water for close to 2 years now, when most others in the portfolio have comfortably, probably luckily in my case, outperformed. Any thoughts on Sol's outlook on the short, medium, or long term? So Sol Pattinson is the company that we're talking about, ASX SOL, Drew, which you know that, of course. Diversified investment company here in Australia, one of the most popular. It probably is the most popular. I was actually looking at this morning because I was chatting to an investor. And if you look at the share price, not the only thing to look at, but if you look at the share price over the last, say, 2 years, it has treaded water. Go back in time, obviously it's a monster and it's done really well. I actually think a treading water share price of a great company is actually the best thing to look for, because if it's growing fundamentally, like if the profits are growing, in this case, if it's like portfolio underneath the overall company is growing, if it's investing well, if it's got good team members, they're all still in place, I actually think it's a great sign. And yeah. So we don't own direct stocks at Rask. We have ETFs and that. But if I was to put an ASX listed company in our portfolio today, it would be Solpats. And I would also consider Wesfarmers, Drew, which is, I don't know if you've seen Wesfarmers recently, but have you seen the share price of Wesfarmers? It's basically doubled. Like, here we go. Here's over 5.
Cool.
It's, in a year, it's gone from $40 to $74. Oh, sorry, 2 years, gone from $40 to $74. This is one of Australia's biggest companies now.
Catching the day.
Yes, it does, my friend. Did they shut it down, did they?
Last week, or might have been earlier this week. Coke and in the last few years. But I think they said they learned a lot from the type of business and the. I think.
Yeah.
I go to a fund or a diversified. I think that's why the share price is stagnated, because it has private credit, it has property, it has private equity. It's diversified, which means you should be expecting the doubling like Nvidia is something that's going to tick away, and not a company. They're essentially targeting that, I think, 8 to 12% annualized return portfolio. So it's particularly hard because there's a risk that it's overvaluing the assets that are in it. It's a
exactly.
company that holds other assets that are operating assets. So
yeah,
not something I'd be overly concerned about. Is CBA $160?
Yeah, I've just brought up this chart of CBA. So it's nearly $160. It's gone from
Quick plot against
$100.
People, how many times CBA is a sell?
Not
CBA is a
including
sell
dividends
from.
It was in COVID. It fell to what, $58,
Yeah.
and now it's 160 plus dividends. You probably got more back in dividends. Josh Percy in the chat says the investing app I use, which is CMC Markets, has Morningstar's recommendations and the tip ranks review tab. How much faith do you think one should put in these reviews? Should they sway you to purchasing or not? Now, I'm just going to answer this generally speaking, but for me, Josh, absolutely bloody not. So I don't I don't use a CMC, obviously, but absolutely, positively zero attention is paid to those types of things. And the reason that I say this is that a lot of those things that you see inside your brokerage accounts are one of two things. They're quantitative reports. So they're just basically saying, like, someone writes a formula and it's like, if PE ratio below 20 equal buy, if over 20 equal sell. It's just dumb investing. That's how those quantitative models work. And it's really, really basic. And some of it probably hasn't been updated for 25 years. And I mean that sincerely. The other thing is that for the more qualitative stuff, like the broker reports and that sort of thing, they're very biased because oftentimes the broker reports are brought out by companies like, I don't want to throw shade on them necessarily because there is some good research amongst it, but things like Goldman Sachs, UBS, a lot of those companies that produce that research are what we call sell side analysts. So they're effectively producing the research because they're required to by their employer, being UBS or Goldman Sachs, just in case someone comes along, one of their clients comes along and needs research on that stock or whatever. It doesn't mean that those analysts aren't good. It just means that they're a bit conflicted in what they're actually doing, and their alignment of their investing goals and their career goals, frankly, may not always align with yours. So that's one thing to keep in mind. So just long story short, no, there is some great research out there. I do use broker reports sometimes for things like if they've gone and done an interview with management that's not public, or they've gone and visited a site of a factory and they've taken photos and they've explained what it's like, or maybe they've done some research on some competitors. So I take it from the perspective of information gathering, and absolutely in no way do I use them as a signal to buy or sell. That is not at all. I got lucky one day, and then about the next 10 times in a row, I got very unlucky from trying to invest that way. And I've learned my lesson just like everyone else. Drew, there's a question.
It's something the stat on me, but there's you look at average broker research, and it's something like, I'm sure someone will comment on this, is 60 to 70% of broker research. Always a reason, just a time for no one wants. So I think it's always going to be towards look at it, the data and therefore, but it's not.
I think we might have lost you there, Drew. I think your internet connection may be breaking up. So we might need to get you to reconnect in, good sir. If anyone else is having issues, hopefully Drew can quickly rectify that. But we're almost coming to the end, my friend. So Graham did send a question in, and it says, I didn't get a notification that the live session was on. May explain the lower turnout. Danger if it's oh yeah, there's very much a danger if small number of brokers covering due to a capital raise. Yeah. So Drew, we've got you back. Thank you for rejoining us. You're looking just as trim as you were a few minutes ago. So well done to you, sir. But Graham, yeah. So this is not actually a formal live show. So we'll be going live again starting next week on the Rask YouTube channel. This is part of the Australian Investors Podcast. A few folks have actually mentioned that we have like a lot of shows going at the moment at Rask, and we've got a podcast coming out each and every day, and they all feature a video, so they're all on the YouTube channel, and more of them will be going live in the near future. Maybe Drew, we've got time. If you're back with us, you're still a little bit pixelated, maybe on the Nokia 3310 there, my good sir. So at risk of throwing it back to you too soon, I might answer one more question, and this is a question that comes from What's the Momo. The question is, I may have been living under a rock, but have only just heard about momentum investing. Can you guys please discuss? Is this a strategy that has been used for a long time, or is it something new? Pros, cons, and opinions appreciated. So what I might show you is I might bring up my screen because I think we've still got a pixelated Drew here. So I'll pop him away for a sec. But momentum investing, factor investing. So what this is basically, let me break it down for you super simply. Momentum investing is basically like saying this. If you got all the stocks on the ASX and you got all of their share price returns from the past 12 months, and then you rank them by like highest return to lowest return, the factor called momentum, it's a term called factor, which is like the factor that we're looking at, would say that the momentum stocks are the ones at the top. They've got the most momentum. So what do you then do? The next thing to keep in mind is that where does this come from? This idea of momentum comes from the saying, winners keep on winning. And so it effectively says to you that if there's a winning company, it will keep on winning. And does it always work? Absolutely not. Graham's used a chat here. A comment in the chat here to say momentum example is Pro Medicus. Yes, it is. And it's true that, and I'll bring my screen up. I'll show you something from BlackRock. It's true that momentum investing has some level of efficacy, meaning that stocks that win tend to keep on winning, which is contrary to what most people think about stock investing, which is that buy low, sell high, because most people are trained in their brains to they've heard that phrase before. If I buy it low and then I sell it high, I'm a good investor. But realistically, it's quite the opposite of that. The momentum factor actually says that that's not true. If it goes high, you should buy again. And so ultimately, the momentum factor is quite strong, but it's not perfect. So here we go. The BlackRock definition is momentum is a style factor which seeks increased exposure to companies that are outperforming and decreased exposure to companies that are underperforming. The key consideration, and you can see it here just in more fancy language than what I use, it says momentum strategies aim to capture the stock with strong recent performance by identifying companies with high price performance in recent history, up to 12 months. So we say winners keep on winning. The fund managers say momentum investing. And realistically, does it work? It's not perfect, is what I'll say. And ultimately, what we should be thinking about is how does that type of company blend with other things? And if you ask me, winners do keep on winning. And if you want a good example of how it works really well, is actually go and look at the Motley Fool's David Gardner and his investment process. I think he's got the best all-encompassing kind of framework for identifying companies that do keep on winning. He uses he's got, I think, 6 investment criteria, and one of the things that one of the key criteria that he looks for in the companies that he's buying is it a top dog and first mover? So meaning that is it is it in an industry? Is it the big dog in that industry? Like, even if it's not like a big company, is it winning in terms of mind share and attention and products, services, or is it winning in terms of what people think is the best? Another element that he might look for is it isn't in an emerging industry. So not only are you the biggest in that industry, but is the industry itself growing? So you're kind of riding the wave. And then another criteria that he looks for is, has the traditional media, so like the news, the brokers, the podcasts potentially, has the traditional media called it overvalued? And if you think about it, he's effectively saying, nah, what you guys are saying about buy low, sell high does not make any sense, because winners keep on winning. And if you just look at David Gardner's track record, it speaks for itself. He's probably one of the best investors in the world over the past 30 years, if not the best. And so that is what momentum investing is in terms of a statistical thing. And when you look at ETFs, it's really just whatever did well in the recent memory. We don't use them at Rask because index funds are actually momentum strategies. And by that, I mean, the data seems to suggest that index, like say like the VAS ETF or the S&P 500 IVV ETF, what happens is, if you think about it, within the ETFs themselves, the smaller companies become bigger as they get bigger. So I know that sounds kind of like nonsensical, but effectively what happens is bigger companies tend to get more of the money from the ETFs and they tend to go up. And it's not necessarily a Ponzi scheme, because effectively what happens is the earnings are going up as well. So effectively what you're seeing is like good companies being continuously rewarded within the ETFs until it gets to a point where Tesla's the biggest in the world, or Apple's the biggest in the world, and companies like ExxonMobil or the railroad companies or tobacco companies are no longer the winners. So index funds, I don't think that when Dimensional and all those fund managers invented index funds that they thought this, but what we have realized is that the funds tend to reweight to bigger companies. And the final thing is that I'll say on this is that many people who criticize index funds for being momentum driven haven't actually looked at the data. They don't actually know what they're talking about, because most of them blame index funds for companies getting bigger. And that's not what the data tends to support. It may have some impact, but it's not the majority of the impact. Most index funds actually don't have momentum in the individual stocks, like I was just saying. But what they tend to have, they tend to show momentum in the industries that they tilt to. So this is a very nuanced point, and sorry for getting super nerdy on you, but effectively what that tells us is that as industries become more important in society, index funds tend to reweight to those industries. And so we can see that at the moment. That's why a lot of the index funds around the world are being increasingly dominated by technology companies and IT companies rather than traditional industries. And that's why you end up with index funds winning a lot, and why it's so hard for active fund managers to beat them. Sorry if I went down a wormhole there, but or through one. I'll just quickly answer some questions, and then Drew wasn't able to reconnect. So hopefully wherever he is, the internet lords come back. But Lav P said, is Invest Smart Fund later worth it, considering the monthly fee and the current prices? Lav P, obviously, generally speaking, Invest Smart offer a product, which is pretty cool in my opinion. It allows an investor to put in $4,000, and then Invest Smart will match that with $6,000, giving you a $10,000 portfolio. And they charge, off the top of my head, I don't have everything in front of me, $25 a month. And that may be tax deductible because it's basically an investment fee. And so once you do all the Jenga and gymnastics in a spreadsheet, what you'll find, or what I found anyway, is that the effective interest rate is 8.6667%. And so what that effectively tells us is that that is the effective interest. It's not called interest, but it's effective interest. There are some quirks about that product and the way it works, but there are other options like NAB Equity Builder, and there's a few others. Do I think it's a great one? Oh, thanks, Lav. You have confirmed it's $25. Yeah, so if you do the math, Lav, if you were to go $6,000, and then you were to calculate, so that's the full amount that they would chip in, and then you calculate the $25 as effective interest, I think it works out to be about 8.66% per annum. I could be wrong. It's been a few years since I've done the math. But when that came out, I thought this is actually pretty good, because if you're a grandparent and you want your children to start investing, you could ask them, hey, you chip in 2, I'll chip in 2, and then we'll get a $10,000 portfolio, but you've got to make the repayments of $200 a week. So the way that they get their money, the InvestSmart, basically it's forced savings. It's like a mini home loan, and it tries to instill upon people the idea of dollar cost averaging. And obviously InvestSmart require you to invest in their ETF portfolios, which is fine. But at the end of it, most people would just keep adding the $200 because now it's part of their budget. And that becomes like forced savings, kind of like a mortgage. And it's actually a really good habit for people to form. So I actually don't think that it's a terrible thing. Would some CPA that's out there crunching the numbers say it's the best thing in the world? I don't know. Probably not. But I think for behavioral bias, it's pretty good. Final one here is from Cliff. Do you have a list of tools/websites you access to research ETFs outside of the issuer's website? Absolutely. There are different tools you can use, Cliff. What we use is we kind of do it ourselves, but there are some great tools. I think you can even use the tool if you already use ShareSite. ShareSite does this diversification report, which is free. On our website, we have a fund compare tool, so it allows you to compare ETFs for things like risk or deviation, returns, total returns, and that sort of thing on the fly. Vanguard also has one, which is you can just Google Vanguard Fund Compare, and it compares the top 10 holdings, the returns, the fees, all that sort of stuff. Morningstar is probably my go-to for research. So you can go to morningstar.com, sign up for a membership, and from there you can get research on ETFs, on managed funds, and stocks all in one place. I have a membership to morningstar.com, not .com.au. I just find the interface is much better. Final one here then. Lav said, are you thinking of bringing that type of product to the Rask platform? I'm sure a lot of us would appreciate it. So Lav, yeah, I mean, in terms of fund later, yeah, I would consider, I should speak to the guys at InvestSmart because it could be doable, as in, they chip in the money and whatever. But ultimately, it is a bit of an admin thing. From our end, we've got more portfolios on their way out, on way in. So we're kind of busy researching for those. And I'll let you know, Lav, if you're on our mailing list, you'll get all the weekend email anyway. I'll keep you updated. Got some big news coming up in the next couple of days. Hey, Drew, you're back, and you're back just in time to give us a dad joke. If this connection holds, mate, it's too much congestion. You must have like one of those cheap Telstra internet connections or something. Not the Aussie broadband.
Telstra plus the banging on the modem for like 10 minutes while I was trying to get back online. I'm hoping you covered the momentum question anyway. And I mean, ultimately,
that's all good. All we need from you, good sir, is your dad joke. That's all we need, and then we can close out the day because we're already over an hour, and the good folks have got plenty of their Friday to get on with. Says Love P says thank you. So while you're doing that, I will pick this week's. Actually, I don't need to pick this week's best questioner name because everyone gets some Rask merch. If you are one of the people, pronunciation, not empty nest, pickle down Rickonomics, or what's the Momo, you can just write into us and you'll get some free Rask merch delivered to you sometime in the next 2 weeks. You'll see like the hat I've got on today, and we've got t-shirts and all that sort of stuff. They're going on sale this weekend. So Drew, do you have a dad joke for us, or have we lost you again? Okay, folks, it looks like we've lost him again. So Lav, Graham, everyone. Oh, here we go. Okay, I got you. Give us your dad joke, and then I'll read out Graham's.
Oh.
Okay, Drew, we have completely lost you, so I'm going to kindly exit you from the discussion, and I'm going to go with Graham's for this week. So, Graham, thank you for rescuing us. We've got, did you hear about the ATM that got addicted to money? It suffered from withdrawals. Graham, I'll give you an 8 out of 10 for that. I think that's bloody good. It's on the theme of finance, and it's on the fly as well. So thank you, good sir. What did the Pirates say on his 80th birthday? Hey, matey. Got that one. That's not bad. Drew actually has just jumped in the comments to say that's not an 8. Well, Drew, you're going to be back next week with a good internet connection, fine sir. But it's been good to chat to everyone, including you, Drew. We'll be back next week. Remember, every Saturday morning at 7 a.m. podcasts. That's when it comes out. But also on a Friday midday is when we're aiming to go live for the Australian Investors podcast. So join us, subscribe to the YouTube channel, check out the Australian Retirement podcast if you want more from Drew. There is a link in the YouTube description and the podcast description that will go to the page that will have the live portfolios updated of the $10,000 challenge. So that's coming up each and every week. $10,000 challenge. See all the stocks there. Not a recommendation, but have a wonderful rest of your week, everyone, and bye.